Security Analysis by Ben Graham. It is a very difficult book to read, definitely not for beginners. I will try to simplify as much as possible in less than 9 minutes or so. Even though it's not an easy read, but at the same time, it is the most comprehensive investment book was ever written, an all-time bestseller, and Warren Buffett has repeatedly praised his investment success and evaluation skills he gained through this book. Security Analysis outlines 3 key concepts. Number 1. What is the difference between speculation and investing? Number 2. How much money is the company really making? Number 3. How can the balance sheet reveal the truth about the company? Number 1. What is the difference between speculation and investing? According to Graham, an intelligent investor must identify what it really means to invest before he can even consider buying securities. Many people may think they are investing, but in reality, they take unnecessary risk and expect unrealistic growth prospects. When you invest, your primary action must be to protect your principal and then search for acceptable returns. You should never search for high returns first and then evaluate if the risk associated with the investment seems reasonable. Many people perceive bonds as a sound investment options as opposed to stocks that may appear speculative. The reason for the general truth in bonds is that it is really a loan issued by the bondholder to the issuer or a company that desires to raise money. The issuer of the bond has the obligation to pay the interest to investors before honoring other obligations such as paying dividends to stockholders or reinvest potential earnings to grow the business. According to Graham, fixed income securities like bonds do have inherent characteristics that make them appear as a sound investment choice. But investors should never forget that the risk of any security is highly dependent on underlying an asset. Since the bond is a loan, and the loan can never be more secure than the quality of the issuer you decide to lend money to. Even the large company issuing bonds may be very speculative. On contrast, it would be also wrong to conclude that stocks are always prone for speculations. While stocks often seem very volatile, the investor perceives that the underlying value of the stock is the value of the business it represents. Owning a piece of stable, profitable real business does not make it speculative, even if the price of the stock suddenly drops. In the field of investment, any purchases of security must be justified, both qualitative and quantitative, before any purchases. A quantitative analysis of the company includes a thorough study of the financial statements of at least 10 years. This type of analysis includes the calculation of a number of key ratios and the deep understanding of why the ratios have changed the way they have. A qualitative analysis is conducted by looking into the future with the attempt to estimate what could happen. Future is always uncertain. The investor will base his estimation on his profound knowledge about the security, while the speculator is more likely to be merely guessing. This is also where an equally important distinction between an investor and a speculator occurs. A speculator hopes that the future offers him a better opportunity than the past and relies on the future growth to justify his current market price. The intelligent investor may hope that the future is better, but is by no means he relies on a bright future. Even if the future doesn't hold escalated earnings, he would still have a sound margin of safety between what he estimates what the value of the asset is and the price he pays. Concept 2. How much money is the company really making? For many new investors, the discipline of reading an income statement is very simple. They look at the bottom line where the net income is located and take that number for granted, assuming this is how much money the company is making. Once you take a closer look at security analysis, you will be surprised how Graham presents a variety of accounting methods that demonstrate how much reported net income deviates from how much money the company is actually making. Some of those techniques are intentionally conducted to misinform the investors. One account the investors should pay careful attention to is the non-current expenses and revenue. For example, let's imagine a profitable company that is typically making $1 million in annual profit with a series of unrelated great investments and gains $2 million for a specific year. What do you think about how profitable the company is now? If you paid attention to the bottom line, you would see the profit of $3 million. But is that really the profit you want to base your analysis on? Utilizing its core business, the company is making $1 million, and it's the most reasonable to value the company based on this number. However, there is absolutely no guarantee that the profit of unrelated business will repeat itself. If you are equipped with the knowledge of not reading only the bottom line but separate accounts as well, you won't fall into the trap of overpaying for the company stock that benefit from one single lucky year. When looking back at the past earnings, Graham also warns the analyst about very common misperception. The trend is overemphasized. For instance, if the stock's EPS is steadily increasing by $1 each year, let's say from $3 to $7 over the past 4 years, there is no guarantee that the next year profit will be $8, and it's even less likely that you can continue the trend line the further you go into the future. Clearly, a positive trend is a good thing, but the analyst should be very conservative and rely closer on current earnings than placing his hope into the future. On contrast, with negative trend of earnings can be observed, it wouldn't be a good practice to just assume that negative trend will continue. It might be possible that the entire sector experienced a downturn and the reduction of earnings could be less bad when you compare them to similar companies. Stable earnings rather than volatile allows for a better prediction of what will happen in the future. New products are typically examples of volatile earnings. Initially, the company in the market top position will capture large market shares and sets the higher price with the higher profit margins as a result. A new entrance to the market drives down the price and artificial high earnings can no longer be sustained. Future earnings can be estimated if you really understand the business and the sector. Even the best companies can lose money in a bad time, and even the worst company can profit when the market conditions are perfect. The analyst should always question himself about which state the sector is in and how the specific business is able to respond to changes. Section 3. How can the balance sheet reveal the truth about the company? As the intelligent investor knows you need to study a different financial statements to get the full picture of the company. The income statement only shows one side of the coin, but financial analysis cannot be conducted without examining the balance sheet closely too. One of the many purposes of the balance sheet, and perhaps the most important one, it is the ability to discover financial weaknesses. A typical financial weaknesses to investigate is whether short-term liability can be paid by the cash that can be expected to flow in the near future. If not, the company may need to incur additional debt. For this reason, Graham points out that the investor must find companies with the current ratio of at least 1.5. Additionally, he even suggests that an asset test ratio about 1 is essential, meaning that the short-term liability still be met, even if the company hasn't sold any of its inventories for the next 12 months. The balance sheet also reveals how the company is structured financially. A highly profitable company that is financed primarily by debt and not by equity might be headed into trouble in the bad times. This was a quick summary of security analysis, a very difficult book to read that contains very profound principles. Similar and easier book I would highly recommend is The Intelligent Investor by the same author, Benjamin Graham, and recently I conducted an animated video summary, and if you guys are interested, I'm going to put the video in the description box below, and thank you guys so much for watching.